If you're saving for retirement, you've probably heard these terms, IRA transfer or rollover IRA. They might sound the same to you, but in the financial industry, there's actually a very important distinction between an IRA transfer and a rollover. So let's define both. First, let's talk about transfers. Transfers are the most common way to move money from one retirement plan to another, and specifically from one IRA to another. They're very easy to do, and you can do unlimited amounts of transfers within any given year. Let's say you have an IRA, a traditional IRA at Fidelity. That traditional IRA is a pre-taxed IRA, and let's say you want to establish a pre-taxed IRA at Nuview Trust Company. In order to move money from the Fidelity IRA to the Nuview IRA, all you have to do is an IRA transfer. How to process that transfer is you always fill out the transfer paperwork with the receiving custodian. So wherever you're trying to move the money to, they should have a transfer form. You fill out that transfer request that's sent to the current custodian, and they move the money via wire or via check. The important thing about transfers is that they're not reported to the IRS, but you have to move them between like accounts. And when I say like accounts, I'm talking about how they're taxed. Traditional IRAs, SEP IRAs, and simple IRAs that have been established for more than 2 years are all pre-taxed accounts. So you can transfer money from those accounts to another IRA at another custodian without having to report it to the IRS, and you can do it as many times as you want. But if you want to move money from, say, a traditional IRA to a Roth IRA, since those are taxed differently, that has to be moved through something called conversions. We'll talk about conversions at the end of this video. Now let's talk about rollovers. Rollovers are a little bit differently. It's still the process of moving money from one retirement plan to another, but with rollovers, the biggest difference is that they are reported to the IRS. They're reported as a distribution from the money leaving the current custodian, and they're reported as a rollover contribution to the new custodian's retirement accounts. You often are forced to do rollovers when you are, say, breaking down an old employer plan. Let's say that you've worked at a job for X amount of years, you're leaving that job and you have a 401k with that company. Oftentimes they're going to force you to leave that plan, and since a 401k is not like an IRA, they're not like accounts, you have to distribute the money from the 401k and roll it into the IRA. Now there's two different types of rollovers. There's what we call a direct rollover and an indirect rollover. The differences between the two is a direct rollover is when the sending custodian makes the check payable to the receiving custodian. For instance, if it's a Fidelity 401k and you're moving it to a Nuview IRA, the rollover check will be made payable to Nuview IRA for the benefit of your retirement account. Now you can do direct rollovers as many times as you want, okay? And there's no time frame as to when the money has to leave the custodian and arrive to the new custodian. This is different than an indirect rollover. An indirect rollover is where the sending custodian makes the check payable to you. When they make the check payable to you, there's really no guarantee of what you're going to do with that money. If you deposit that money in your own bank account, you have 60 days to roll those funds in to another IRA without having to pay taxes or penalties. So there is a time frame as to when the money leaves the plan and needs to be rolled over into a new plan because the check's made payable to you. You're also limited on how many times you're allowed to do this. Current law states that you're only allowed to do what's called an indirect rollover or a 60-day rollover once every 12 calendar months. So if you do it once, you can't do it again for another 12 calendar months. Now with both types of rollovers, you're going to have reporting. The sending custodian is going to report the distribution on what's called a 1099. Okay? That's a tax form that's going to be sent at the end of the year that shows you distributed the money out of your 401k. And then when the receiving custodian rolls the money in, they're going to send another document to the IRS called a 5498. That usually offsets the distribution. So a lot of people think, well, I don't want to pay taxes on my distribution, And the 5498 is what tells the IRS, no, you didn't take the distribution, you just rolled it into an IRA, and those two forms often offset each other. So let's talk real quick about some pros and cons between transfers and rollovers. Transfers, remember, you can do an unlimited amount. So you can transfer 100 different times between IRAs at different custodians, and you don't even have to report that to the IRS. Depending on the custodians that you're working with too, it can often be much faster and there's no paper involved, meaning they don't have to cut a check to do a transfer. Oftentimes they can just send the money via wire. Check with your current custodian though on how long their transfer process takes, because it's different between different banks and different custodians. Now when it comes to rollovers, rollovers are started and initiated by the sending custodian. Okay? The sending custodian should have paperwork, rollover paperwork, that asks you, where are we sending the check to? Are we making the check payable to you, or are we making the check payable to your new IRA custodian? And there's going to be reporting involved through a 1099 and a 5498. Now be very careful that you make the distinction between a direct rollover and indirect rollover. Direct rollovers you can do as many times as you want. Direct rollovers, there's typically no tax withholding. Direct rollovers go straight from the sending custodian to the new custodian. Indirect rollovers go to you. When the money comes to you first, there's going to be tax withholding. When the money comes to you first, you've got 60 days to make a decision to roll that money back into an IRA or retirement plan. And again, when the money comes to you via indirect rollover, you can only do that once every 12 calendar months for all your plans. Now the last thing is I wanted to revisit conversions. A lot of people decide that they want to take money from a traditional IRA and move it to a Roth IRA. Since those are not like accounts, that has to be done via what's called conversion. When you do a traditional to Roth IRA conversion, you're deciding you want to pay taxes on the money in your traditional IRA and move it to an after-tax Roth IRA. So there is government reporting here. It's similar to a rollover, where you're going to have a 1099 issued at the end of the year for the amount you decide to convert, but it's going to show a rollover contribution into a Roth IRA. Now this could create a taxable event to you, but we have a lot of education, and watch some of our videos on how to analyze a Roth conversion, because it might make sense to pay taxes now versus pay it later, but just wanted to make that comparison between transfers, rollovers, and conversions and how they're different. And if you ever have any questions, make sure to reach out to us. Contact us, email us at iraspecialists@nuviewtrust.com. And for continuing education, make sure to like us on Facebook, follow our live Wednesday workshops, and subscribe to our YouTube channel as we post more content and more education to help you guys be better informed.